Most people imagine money being created in a single obvious way. A government prints it, a central bank issues it, physical bills enter circulation, and prices rise as a result. This explanation feels intuitive, visual, and simple. It is also deeply incomplete. The vast majority of money in modern economies is never printed at all. This episode is about how money is actually created, quietly, invisibly, and without a single bill ever leaving a printing press. Chapter 1. The illusion of printing. When inflation rises, public attention turns toward physical currency. Images of printing machines, stacks of bills, and expanding balance sheets dominate the conversation. This imagery is powerful because it gives inflation a visible culprit, but focusing on printed cash distracts from the true mechanism at work. In most developed economies, physical cash represents only a small fraction of the money supply. The rest exists digitally, as numbers on screens, ledgers, and balance sheets. This money is not created by printing presses. It is created through lending. The invisible economy begins here. Chapter 2. How banks actually create money. When a bank issues a loan, it does not lend out existing money in the way most people assume. It does not take deposits from one account and move them to another. Instead, it creates new money at the moment the loan is approved. The borrower receives a deposit. The bank records a loan as an asset. Both appear simultaneously. No physical money changes hands. No savings are transferred. New money simply enters the system through accounting. This process is known as credit creation. It is legal, standardized, and foundational to modern finance. Every mortgage, business loan, and line of credit expands the money supply without a single bill being printed. Money is created through permission, not production. Chapter 3. Why lending, not cash, drives inflation. Because money is created through lending, inflation is less about how much cash exists and more about how much credit is extended. When lending expands rapidly, purchasing power increases. More money chases the same goods and services. Prices respond accordingly. When lending contracts, the opposite happens. Money disappears as loans are repaid or defaulted on. This is why economies experience cycles of expansion and contraction even when physical cash remains relatively stable. Inflation is not primarily a printing problem. It is a credit problem. This distinction matters because it shifts attention away from visible symbols and toward invisible incentives. Chapter 4. The role of central banks. Central banks do not create most money directly. They influence how much money is created by shaping the conditions under which banks lend. Interest rates, reserve requirements, and regulatory frameworks all determine how attractive or risky lending becomes. When rates are low, borrowing feels cheap. Lending expands, money supply grows. When rates rise, borrowing slows, lending contracts, money supply tightens. Central banks do not push money into the economy. They open or close the gates through which money flows. This is why inflation can rise even when governments are not printing aggressively, and why tightening monetary policy can slow inflation without removing physical cash. Chapter 5. Why this system persists. Credit-based money creation is not a flaw. It is a design choice. It allows economies to grow beyond the limits of physical currency. It enables long-term investment, infrastructure development, and economic expansion. But it also concentrates power. Those who control lending standards, access to credit, and terms of borrowing wield enormous influence over who can act, invest, or expand. Money enters the economy not evenly, but selectively, through approved channels. This is why access matters more than effort. Those closest to credit creation benefit first. Those further away experience the consequences later, often without understanding the cause. Chapter 6. The psychological effect. Because credit creation is invisible, its effects feel abstract. People experience rising prices, higher debt burdens, and reduced purchasing power without seeing the mechanism behind them. Inflation feels like an external force rather than a structural outcome. This leads to confusion and misplaced blame. Individuals blame corporations, governments, or themselves. Rarely do they examine the system that determines how money enters circulation in the first place. The invisible economy thrives on this gap between experience and understanding. Chapter 7. Why cash is a distraction. Physical cash plays a symbolic role. It is tangible, visual, and emotionally charged. But focusing on cash obscures the true scale of money creation happening digitally every day. When people worry about printing presses, they miss the loan approvals. When they fear currency debasement, they overlook balance sheet expansion. The system remains unchallenged because its most powerful mechanisms are hidden behind routine financial operations. Money does not need to be printed to change behavior. It only needs to be allocated. Chapter 8. Seeing money clearly. Understanding how money is created changes how you interpret economic events. Inflation becomes less mysterious. Debt becomes more structural. Stability feels more conditional. This awareness does not require panic or withdrawal. It requires clarity. Once you see that money is created through lending, not printing, many familiar narratives lose their grip. The invisible economy does not hide the truth deliberately. It simply does not explain it. The first layer. This is the first layer of the invisible economy. Money is not primarily a physical object. It is a permission system. It expands through credit, contracts through repayment, and shapes behavior long before anyone notices. Understanding this does not make you wealthy. It makes you precise. And precision is the foundation of any meaningful understanding of how the modern economy actually works.